Thank you so much for joining me this morning, giving me an hour of your time. I really appreciate it. Because we have a lot of information to cover, I'm going to be efficient with my time as possible, getting through the material. Please ask questions, send them in the chat box throughout the webinar. To ease the webinar today and the presentation, we'll go through the entire presentation and then I'll address any questions at the end. Before I get started, I also want to mention and thank two of my associates who did a lot of work and assistance with research and preparation on this presentation this morning. So I want to give mention to both Chris and Jack. Thank you both very much. So today our learning objectives are, we're going to cover business valuation and current issues that are related to COVID-19 and how that impacts the valuation landscape. We also are going to be addressing where do we go from here. So talking a little bit about the current environment and then looking ahead into what we can expect in the next several months and years and preparing for the future. So we'll end with some opportunities for succession planning and ways that we can, again, prepare our business for the future and for a transition. Next slide, please. So in order to assess the impact that the coronavirus is having on business valuations, I think it's important to first step back and go back to the basics, so to speak. Business Valuation 101. Advance the next slide, please. So I want to give a brief overview to the main types of valuation approaches and how we, as a business valuation analyst, derive the enterprise value of business. And then with that understanding, we'll get on into our presentation as it relates to the COVID-19 impact. So the three common approaches to business valuation are the asset approach, the income approach, and the market approach. The asset approach, again, keep this in context, this is pre-COVID. The asset approach is typically the approach that sets the floor value for a going concern company. It's only looking at the tangible value that a company has. So think about your balance sheet. A real easy way to look at it is your assets minus your liabilities. It fails to capture what we call goodwill or the intangible value of your business. Oftentimes, if the asset approach is our highest approach to value when valuing a business, then we'll go through a liquidation value, meaning you're liquidating the company, it is not going to continue into the future, and what value could you get for it today? The income approach is based on historical financial performance of the company, as well as management's forecast for future performance. It determines the value of the company based on the future economic benefits to an investor. We do that by looking at the historical performance, financial performance of the company. We make normalizing adjustments, and we derive the future cash flow stream, oftentimes referred to as EBITDA, or earnings before interest, tax, depreciation, and amortization. And then the market approach, that uses multiples of comparable or guideline companies, so accessing databases that have both private and public transaction data points, and then applying those deal multiples to the subject company that we are valuing to derive a value of that company. Within the income approach, there are two commonly used methodologies, the capitalization of earnings or capitalization of cash flows, and the discounted cash flow method. And we're going to get into that a little bit more here in a second, but I just wanted to make mention of that. So some of the valuation considerations that an analyst is using when deriving the value of a company is, as I said earlier, it's both the historical financial performance of the company as well as the forecasted financial performance. For a company that, and again, every company and every industry is unique. And so with everything that we discussed in today's presentation, please keep it in the context of, I understand that everyone's situation is a little different and a little unique. And so some of the information presented will depend upon the size of your company, the industry that it's in, what types of products and services you provide, et cetera. So for some companies that have a very stable and consistent earnings and cash flow stream, the historical financial performance of the company can be very indicative of what the future cash flows will be. Now, while historical results are important, at the end of the day, an investor cares about what the future cash flows of the company will be. that couldn't be more relevant than it is today amidst the pandemic that we're in and the impending recession. While a company pre-February might have historically performed quite well, depending on the industry the company's in, their future might look very, very different. And so that is a key element to valuation that we will be discussing today. So what's now more important than ever is the management's expectations of future cash flows. That can pose and is posing a challenge for so many business owners because we don't know the full effects that coronavirus is having on our businesses, and we don't know how long the effects will be in place. You know, will the recovery period be 6 months or will it take 2 years? It's just so early to tell. And again, it makes it very difficult for a management team and a business owner to come up with a solid forecast that the valuation analysts can then use in their model for deriving the value of the company. We also look at company-specific attributes and risks. So again, this goes back to how diversified are your products and services? What is your competitive environment? You know, how many and how large are your competitors, and what things are they doing to steal or gain market share from you? What does the management team and the workforce look like in your company? Is there depth? Are there layers? Or is there a lot of turnover? There are many other specific company risks and attributes that we assess, and we'll get into some of those in a little bit greater detail later on. And then we also look at industry-specific information. Again, depending upon what industry you're in, whether that's restaurants or retail or construction or professional services, veterinary or dental, each one of those has specific impacts that they are feeling from the pandemic. We're going to look at some private market transactions and also discuss how pre-pandemic transaction data may not be relevant for assessing a market value approach valuation going forward post-pandemic. We need to look at cost of capital data and the valuation date. That's critical, and we're going to be talking more about that later on as well, what the actual date of the valuation is for the company. Please advance. Abby, go ahead and advance the slide, please.
I apologize. My network connection has apparently got lost. Imani, could you open up the PowerPoint and I will make you presenter?
I will. Give me 1 second. I'll let you know when it's good to go.
Thank you, Imani. And you can advance one more time. So the current issues as it relates to the business valuation, the impact of COVID-19. There is no magic number. I've been fielding calls since March, and my team has as well, asking the question, begging the question or the answer of how is this going to impact the valuation of my company? I was planning an exit or transition later in the year. What is the market multiple now going to be? Well, there's no magic number. There are so many factors that we have to take into consideration for assessing the true impact on a particular business. The AICPA did roll out a toolkit for the Statement on Standards for Valuation Services. That is SSVS paragraph 43, which covers or addresses subsequent events as it relates to doing a valuation. So the valuation date is a specific date at which the valuation analyst estimates the value of the subject's interest and then concludes on their estimation of value. The analyst should consider only the circumstances that are existing at the valuation date and events occurring up to the valuation date. So you'll hear from different valuation professionals talking about this. Was the pandemic known or knowable at the time of the valuation date? So if we're doing a valuation as of December 31st, 2019, and we have roughly, I don't know how many, a lot of engagements in process right now that have a 12/31/19 valuation date. But of course, we were waiting on the tax returns to complete our work. And so those were coming out in March and April, right in the midst of COVID-19. And so now we're in the midst of the pandemic. Some of our clients, and because of the industries that they're in, are already feeling the effects of the pandemic, the negative effects, and some positive effects as well. And I'll talk about that in a moment. And so they've been asking, well, how does that play into our valuation now? Well, as of December 31st, 2019, the pandemic was not known or knowable, and therefore we are not going to take that into consideration in our conclusion of value. And it is at the discretion of the valuation analyst who is performing the valuation whether or not they disclose a subsequent event at all. You will see in reports, you may start to see in valuation reports a disclosure. We have begun incorporating that into our reports that are being issued in April and going forward. And we just disclaim that it's for informational purposes only. Advance to the next slide, please. So this is a sample of a COVID-19 subsequent event disclosure that you may see in the valuation report. As of the issuance date of this report, the United States and global economy have been impacted by the coronavirus, which was declared by the World Health Organization as of March 11th, 2020. The pandemic is considered a subsequent event as it was not known or knowable as of December 31st, 2019 valuation date. The significance and duration of the pandemic, including the financial implications on the economy and the company, are indeterminable. Therefore, the potential financial implications have not been considered, and this disclosure of COVID-19 pandemic is provided for informational purposes only. The reason that's important, and I wanted to highlight that today, is despite the fact that some of our clients and their companies are already experiencing the effects of the pandemic, to project that out the rest of 2020 when we're still in the midst of it, and again, we don't know how long this will last and how long and how deep the recession will be that we're essentially going into, to try to come up with some assumptions that we then incorporate into a model that may or may not be realistic or good assumptions, only further, I think, further erodes the conclusion of value because we just don't know. Next slide, please. So the question is, when should COVID-19 be considered in valuation? Again, as I stated, valuations being completed as of 12/31/19 are not to consider the potential effects and impact of COVID-19. But starting March 31st of 2020, they will start to incorporate the effects of COVID-19. And again, that's going to require a deep look and analysis at the company and industry-specific issues that are resulting from COVID-19. We're also being faced with using alternative valuation dates. So two examples of why that might make sense. One, for ESOPs. So companies that are owned by an ESOP, if they're doing a 12/31/19, their annual ESOP valuation, and again, depending on how they're being impacted, it might be necessary, depending on what the plan documents stipulate, it might be necessary to do an interim or alternative valuation date. We're doing that for a few of our clients right now. We've just completed the year-end valuation, and we already know we're going to be doing an interim date just because of the change in value in a matter of one quarter, from a quarter-to-quarter standpoint. And then for estates, when we're considering taxable estates, it makes sense to consider, for depending on, again, on the estate and the business type of business that the decedent had an interest in, whether or not to do an alternative valuation date. And so once again, for a lot of our clients who we're doing estate valuations for, we are looking at and considering an alternative valuation date. And then what we might start to see is it may be more common that we're going to be, a valuation analyst will be concluding using a liquidation value for companies that have been so impacted by COVID-19 that they have going concern issues and may not continue. So that's just something to keep in mind as well. Next slide, please. So coming up with a normalized EBITDA, again, that's our normalized cash flow stream. Right now, going into 2020, during the pandemic and as well as post-pandemic, a question that we're going to be asking our clients and business owners is, if the normalized EBITDA is depressed right now, to what extent and for what length of time do we think it will be depressed? Is it going to be treated as a non-recurring event, one of our normalizing adjustments that we make? there is a potential that in the future, valuations will be excluding the year 2020. And evaluators have discussed the potential of calculating EBITDA C, so C being coronavirus, so looking at an earnings stream before interest, tax, depreciation, amortization, and the effects of the coronavirus. Again, that will be a challenge in determining the exact amount of impact that coronavirus has had on the earnings stream, as well as considering companies that have received PPP loan and other stimulus loans and funding, and how much of that is forgivable, and how does that affect top line and bottom line earnings stream going forward. Next slide, please. The discount rate is going to be another major player in valuation. So again, to derive the enterprise value of the company is three key parts that we're looking at: is the future cash flow stream, normalized earnings or cash flows. You're looking at a discount rate and the growth rate of the company and growth rate of that earnings stream. The discount rate, it's an inverse relationship to value, meaning the higher the discount rate, the lower the enterprise value of the company, and vice versa. The risk-free rate right now, the Treasury bond is held at 3%. The lower the prime rate, but we have an increase in equity risk premium. So Duff & Phelps gives us a cost of capital information, and the equity risk premium increased or will be increasing effective March 31st, 2020 going forward on those valuation dates from 5 to 6%. We're also anticipating seeing an increase in the company-specific risk premium, which all that together is part of the build-up to the discount rate that we use to capitalize our earnings stream. So as these things are happening, these different levers are being pulled, we are going to see an impact to valuations in 2020 and going forward. Earlier, I mentioned discounted cash flow method versus capitalization of earnings. It's up to the appraiser to determine what methodology of valuation is most appropriate given the purpose of the valuation and the company or entity being valued. Both of these methods are very, very common in the income approach, but the capitalization of earnings is heavily relying upon the historical performance of the company. It does take into consideration management's forecast for future earning level and revenue level, but it's heavily reliant upon historical performance. Whereas the discounted cash flows method is relying upon management's forecast of future financial performance, and then discounting that back to the present value to come up with a total enterprise value of the company. There are going to be challenges with both of these methodologies going forward, I believe. So with the discounted cash flows method, because we're in the middle of a pandemic, the coronavirus, what happened historically for some companies is going to be irrelevant and not indicative of the future of that company. And so needing a forecast and an accurate forecast, or as best as it can be accurate, is going to be critical in determining the value of that business. And as I said earlier in my presentation, it's almost too early to tell what the complete financial impact will be. It's challenging from a valuation standpoint. It's certainly challenging for business owners and management to decipher how this is going to impact their businesses going forward. But relying upon the capitalization of earnings may not be relevant going forward as we do valuations into 2020 if a company is experiencing a completely different financial performance and results now that the pandemic has happened. Market multiples will also be affected. So there's been some conversation and discussion in the valuation world about the affected earnings stream versus the unaffected earnings stream, and then looking at affected M&A multiples. So pre-pandemic, what kind of multiples were we seeing in the M&A world? And now that we're in the middle of it and going forward, those multiples are being depressed. Does it make more sense to apply the current depressed multiples to the unaffected earnings stream because we think there's going to be a recovery to a specific company or industry after we clear out of this pandemic, or do we use the affected earnings stream? So again, those are some of the questions that are being asked and discussed. And then again, the public markets, while that's a good leading indicator for a lot of our clients, it's a privately closely held business. And so the difference between what's happening in the public markets versus private transactions. And then another issue that we're going to be seeing is on a discounting side. So when we're valuing a minority interest in a company and we're applying discounts, a discount for lack of marketability, again, depending on investor confidence and willingness to inject capital and buy companies, what is that discount of lack of marketability going to look like going forward? Next slide, please. We also want to take a look at the macroeconomic conditions. And there are a lot of different indicators and data points that help us assess or at least predict what might be happening in the future. So one of the things we're looking at is the GDP growth. In Q1, it was down negative 4.8%. It was the worst quarter since 2008. And Q2 estimates are anywhere from a negative 40 to negative 20%, according to the Federal Reserve and Morgan Stanley. And we had unemployment rate at one point of 14.7%. And mind you, these numbers are always fluctuating, but this is the best information we had when preparing this presentation. Consumer spending has declined by 7.5% in March, and personal income declined by 2% in March. And those statistics were pulled from the Bureau of Economic Analysis. So we have that piece happening in the macroeconomic climate, and then we look at the S&P 500. So obviously there's been extreme market volatility. The S&P peaked on February 19th, and then it dropped roughly 34% on March 23rd. And so we're keeping a close eye on that as we go forward. And then the consideration of the government stimulus. So we've got the CARES Act and the PPP loans, just to name a few. But the injection of trillions of dollars of stimulus money into the economy, what is going to be the aftermath and impact of that on an economic level going forward? Next slide, please. And then we also need to consider or begin thinking about what the recovery from coronavirus will be. So there's talk of a V recovery. That's a recovery where the economy's open back up, which we're experiencing right now, and everybody goes back to work. And we just recover. It's kind of a straight line. Things go up from here, and there's just a nice steady climb to recovery. The U recovery is more of a slow, as economies are slowly opening and people are slowly starting to get back in the swing of things. I'm not going to say normal because I know there will probably very likely be a new normal, but it's a slow, gradual recovery. And then the W recovery, this goes back to the Spanish flu as an example. We have this downturn, the economy opens up, we're all going back into work, and then there's a potential spike or resurgence of the pandemic. Economies get shut down again for a time, and then we start it again, and we open back up. At this point in time, we believe that it's most likely going to be a U or a W recovery period. And to go back, we can think about, what happened during the Great Depression versus the Great Recession versus what I'm hearing is being called the Great Pause, what we're experiencing right now. So of course, we can look back to history to help navigate what we think might be happening for our economy going forward, but it's still hard to tell. And I think two of the other things that are going to be critical factors in this is social distancing, not only the social distancing measures that have been implemented by our government, but also the social distancing that each of us are taking personally. And even when economies are opening and businesses are opening, how does that affect people going forward in terms of the different types of activities they want to engage in, the way consumer preferences will change, so things like that. And then, of course, the vaccine, when we will have a vaccine come to market, is going to play a big impact on the recovery as well. Next slide. We also need to take into consideration, there are many things that we need to take into consideration and many factors, and I'm not going to cover them all today, but these are just some of the high points that I wanted to bring up during this presentation. So we've got the political and governmental impact to all of this. So, for for businesses that applied for and received the PPP loan. Navigating the forgiveness of that loan, how much of it will be forgivable, how we're going to account for the forgivable and the non-forgivable portions of the loan, and how is that going to impact valuation? That's something that we're going to be keeping an eye on and having to consider as we get into it. The loan application, loan forgiveness just came out last week, so we're going to be working through that. And then the upcoming election and the impact that will have on many different things, but one of which is the estate tax limits. And I'll talk more about that later on in the presentation, but that's something that needs to be considered as well. Then some of the economic considerations that a business owner should be thinking about, and just questions that a valuation analyst is considering. How long will the business operate outside of its normal parameters? What type of product and service diversification can we or are we doing because of the pandemic? We've got companies out there who were alcohol distributors who are now producing hand sanitizers, and we've got clothing and retail companies that are pivoting now and making masks and selling masks. And those are just two quick examples, but again, if the company did not have product or service diversification pre-pandemic and has not been able to shift or pivot with everything going on, how is that going to impact the long-term viability of the company? Looking at the impact that sanitation costs, so just the expense from a business standpoint going forward of cleaning supplies and hand sanitizers and supplying masks for the workforce, putting up the glass divider screens, or not glass, but plastic, the dividers within an office or within the business. What is going to be the impact on the cash flow stream to a company for having to incur all these additional costs, health insurance costs as well? And those are just to name a couple. And then how is your supply chain being impacted? And then from a psychological standpoint, considering some of the social or cultural impacts, have consumer preferences changed? So even as economies open up, for some products or services, it could be a time-dependent thing. For example, hair salons. Just because I missed 2 or 3 hair appointments during the pandemic and we were on lockdown and quarantine, doesn't mean that when a hair salon opens up, I'm going to get 2 or 3 back-to-back haircuts. So for some companies or businesses, those are lost profits. They're never going to redeem that. It's just, going forward with business. For other businesses, so I'm thinking of, restaurants and bars, some people, some consumers might be just really itching. The demand for those services might be so high that people are choosing to consume more of that, whatever that might be, consume more of it or at a greater level because they missed it and it was a pent-up demand that is now being released. So just some things to consider, as well as working from home. As that becomes more commonplace, as companies were put in a position, forced to have their workforces, the ones that could have their workforces work from home, and they saw the positive effects or saw the results of their workforce being able to leverage technology and continue to get work done, maybe at a slower pace, maybe productivity went down a bit, but nonetheless, work is getting done. As we go forward, how many of those businesses are going to be considering a work from home model, reducing some of the overhead costs of having, holding real estate and having big buildings where the workforce has to come in and utilities related with all of that. So as we have more of a work from home commonplace environment, how does that then affect other businesses? Does that mean, less middle weekday work lunches? So restaurant business going down because more people are working from home, they're able to cook at home. And there's less of a demand of, going out and doing the middle day lunches at restaurants and business meetings during the day. I was having a conversation with a client actually just yesterday. So his business, he's in the construction industry, and his business was deemed essential. And so during this pandemic, he's actually experienced the opposite effect of so many of our clients. They've done extremely well. March was actually their highest sales volume ever since inception. And this company it's a family-owned business, so they've been in business for 30, 40 years. And the interesting conversation that we were having as it relates to working from home, he said to me, well, if that's the model that people are going to, and you don't have people needing to go into an office, and you don't have people needing to live close to the office, will you then start to see people moving further out into the country, getting land that they always talked about getting, building their dream home or their custom home out in the country, having space from people that they desire, reconfiguring the structure of the home to have dedicated home office. So many of us who don't have dedicated home offices, we kind of had to be nimble and make some makeshift offices while we're all working from home. But he saw that as a real opportunity for his company and where the market might be going for them. And so I thought that was interesting too. So it's not only assessing some of the negative effects that will be happening to businesses, but also some of the positive effects and some of the business opportunities that are going to arise for companies because of the pandemic, and for companies who are positioned in such a way that they can act on the opportunity and seize it. Okay, next slide, please. So are we experiencing a recession? Well, the formal definition of a recession is often recognized as 2 consecutive quarters of negative growth in GDP. So we've got 2020 Q1, GDP was down 4.8%. And what is the future outlook? And as I said earlier, Janet Yellen, she was the former chair of the Federal Reserve, estimates that Q2 will be down roughly 30%, and Morgan Stanley estimates Q2 will be down about 40%. That's pretty significant. And so that would point to, yes, we are headed into a recession. The International Monetary Fund predicted that the pandemic would cause the worst recession since the Great Depression. So not to be all doom and gloom, but being realistic that we are going into a recession. And for some companies and businesses, that means strategizing in a way that they never have before. It means that for those that have been negatively impacted by coronavirus, this certainly exposed inherent weaknesses that existed pre-pandemic. And so how do those companies really become strategic and hone in on those weaknesses and those threats and do what is necessary to preserve the viability of the company and to survive this recession and to move forward into the future? For other companies who were well positioned, had strong cash reserves and strong balance sheets pre-pandemic, and who are not only surviving but thriving during this time, for those business owners, right now presents a major opportunity for not only growth and expansion of their product or services, but also perhaps looking at other companies to acquire, whether that's a company that's a competitor within their own industry, whether that's a business within their supply chain line that they can acquire and remove and own that business and that part of the operation. There's many different ways we can slice and dice it and talk about it, but those are some opportunities, again, for those people who were well-positioned pre-pandemic that can really come out successful and position themselves in a better way and a stronger way to plan out their succession plan. Next slide, please. So how do we pivot into the future? Next slide. Let's talk a moment about what the post-pandemic future for M&A looks like. The short term right now, it's likely going to continue to be very little M&A activity outside of distressed transactions, and that's a general broad view. Of course, there are exceptions to that. Long term, we are anticipating an M&A rebound. Some of the indicators that are suggesting a rebound is the amount of private equity cash that's sitting out there and available and ready to acquire companies. We have eager investors. We had a very solid pre-pandemic economy. I remember reading towards the end, I think it was the end of Q3 of 2019, they were anticipating a slowdown in M&A activity by Q4 and first quarter of 2020. And we really didn't see a slowdown, at least in the beginning of Q1. We really did not see that slowdown. If anything, there was an uptick up until, COVID-19 came across borders and into, U.S. soil, and then everything changed. But there was such a strong, solid pre-pandemic economy that people are confident we're going to have a rebound. And then you've got the aggressive government stimulus at play as well. Closely held companies are still transacting. So Rea Associates has a specialty niche in veterinary practices. We have a lot of veterinary clients, and a few of them I was and still am working with through a transaction that started months and months before this all happened. One closed on April 1st, even though it was just at the height and the peak of, the economy was closing down, the quarantine orders were being placed, the stay-at-home orders were being placed, and the practice owner was scared. He thought, here we go, all this work and time and effort. We had the valuation done. We've got the buyers lined up. Now, luckily they were deemed essential. However, they could not see all patients, so they were limited as well, as so many other businesses were. And we thought, well, what's going to happen? But because they were well positioned and deemed essential, and we had multiple conversations with the buyers, and they were confident that this practice was going to not only sustain through the pandemic, but then continue to thrive and grow on the trajectory that they had been. The deal went through, and it was fantastic. Another veterinary practice, which we just closed about 2 weeks ago, larger practice, several locations. Again, same thing. This all happened, the process started months and months and months ago. And then here we are getting to the finish line, and the pandemic happens. And when we were talking with those buyers, what was so great about that practice is telemedicine, I would say, was not highly adopted pre-pandemic. There were certainly practices out there that were starting to leverage telemedicine. This practice was one of them. All of their locations utilized that, and their clients loved it. Well, as soon as this all happened, they were able to so quickly shift and just leverage telemedicine even more and really not skip a beat. And it was pretty amazing. And so again, I think in that situation, the buyers were confident that, veterinary services is an essential service offering. That's not going to go away. People still have pets, and pets are part of Americans' families. And we just need to think about how we might work differently to sustain our growth model. And then we've got other clients who, again, are in industries that are actually thriving because of the pandemic. So one who's got a very diversified service offering, and one of the service lines is in the healthcare space, offering air filtration in hospitals. So they are experiencing such an increase in demand for their services that it's almost difficult to keep up. So I'm not trying to paint the picture that M&A activity is not happening. It hasn't all completely come to a grinding halt. It is certainly slowed down, but we're hoping that things will pick up. Next slide, please. So some of the questions to assess the impact to valuation, again, depending on the purpose of the valuation, the date of the valuation, and what type and size of business you are and what industry you operate within, the answers to these questions are going to help evaluator assess what the total impact evaluation will be on your company. So to what extent has the coronavirus impacted your business's sales and profits? Are the impacts going to be temporary, or are some of them going to be permanent? And how do we quantify that? How long do you think it'll take your business to recover? Will your business return to pre-pandemic levels, or will there be a new norm? And if so, for so many businesses, what does that new norm look like? And what impact will the coronavirus have on your customer base or your supplier base? How is the competitive environment of your business changing during the pandemic? So how are your competitors reacting? What are they doing? What are they not doing? and how does that change your competitive environment? What are the barriers to entry now within that industry? And how can you best position your business to be successful following the pandemic? There's many more questions to ask, but those are just some of the high-level ones to get you started. Next slide, please. So part of valuing a company as a business owner, we create value, we build it, we create it. The key right now is protection, more so than ever before. Especially for privately held companies, businesses that are family owned, that have been in the family for generations and generations, to spend all that time and effort building and creating your business and creating value. Now we want to protect that value so it can be transferred in whatever manner that might look like. Again, some of these stats are pre-pandemic, but 76%, roughly 76% of business owners plan to transition over the next 10 years. That number might be way up given our current situation. Around 4.5 million businesses, that's the number, and over $10 trillion in wealth that will be transferred. And yet 49% of business owners have no transition plan. More than 70% of businesses that are taken to market do not sell. And only 30% of family-owned businesses transition from generation 2, and only 12% survive after generation 3. Next slide, please. So the state of owner readiness, and this is a question as a business owner you should ask yourself. Does having a transition strategy, is that important for both your future and for the future of your business? Well, when polled, and again, this was pre-pandemic, 61% of business owners that took this survey strongly agreed, and 30% agreed. And yet, 79% of them had no written transition plan. And I think now more than ever, clients are coming to us and saying, this is something I should have been working on. I've been meaning to start my transition or my succession plan. It's just been on the back burner. Well, now more than ever, I want to get things lined up and figure out, what that next phase of life looks like. What is that next act? There's no time like the present if our current situation isn't indicative of anything can happen tomorrow. There's no time like the present to start acting on it and developing a succession plan. Next slide, please. So 50% of exits are involuntary based on the 5 Ds, but I've changed the slide to add +1C. So the 5 Ds that typically cause involuntary exits are death, disability, divorce, distress, and disagreement. Now I think we're going to be seeing a lot of involuntary exits due to coronavirus. Next slide, please. Business owners want a lot of things, and here are some of the things that they want. They want to understand the value of their business. What is it worth today to an interested buyer? What could it be worth tomorrow? And what do I need to do to get it to the ultimate value, the best in class value that I want it to be at so that I can exit on my terms? They want to be able to maximize value in good and in bad times. Right now, we're in some bad times for a lot of folks. So what can we do to maximize the value of our business? How do we preserve and protect more of the wealth that we create? I want to be able to control how and when I exit. I want to shorten any kind of due diligence process that might be necessary to transition out of my business. And I want to have strategic options to choose from. At the end of the day, as a business owner, I want to know that my future is secure. Next slide, please. So exit planning, that's simply good business strategy. Next slide. So the solution to coming up with an exit plan, particularly for companies that are in a state of distress right now, given everything that's happening, is coming up with a roadmap. I always tell clients when I'm talking with them is, where do you want to go? Where do you see yourself getting to? What is the ultimate goal? And they have no problem describing to me what that point looks like or what that place is. But then they want to know, how do I get there? Well, we have to establish point A to help you craft a plan and successfully get to point B. So that's why I call it developing the roadmap. So we have a triggering event where we do a business valuation or a calculation of value, but we do something to establish the starting point, point A. Here's the value of the company today. And at the same time, the business owner should really be doing a personal and financial assessment. What does their own personal balance sheet look like? If they're not working with a financial advisor, they absolutely should have that person involved with this entire process, because there's three legs to the stool. There's the personal leg, there's the business leg, and then there's the financial leg. And all three really need to be aligned in order for a transition of any kind to be successful. And so then after the triggering event, there's the period of preparation. So so in this situation, the triggering event could be the pandemic. And actually, a quick side story, I was speaking with a prospect. It probably started, our conversations I think started right in the beginning to middle of February. And a family-owned business, she took it over from her father, really wanted to start her succession plan, but just couldn't quite pull the trigger. We'd had a couple of conversations, and she was getting ready to make a decision. And it verbally had agreed to, let's move forward, let's do the business valuation. I want to prepare my business to sell. And then a week later, the pandemic happened. And she called me up and she said, well, pump the brakes. I'm not going to take this on right now. We have to see what's going on. I said, absolutely. I understand. We'll circle back. Take care, stay healthy. And about 3-4 weeks into quarantine, she called me back up and said, this has made me realize that I am really ready to get out of business. I'm just ready to be done. So the next part after the triggering event is preparation. So that includes business improvements and de-risking the company and preparing it for an interested buyer to come in and want to invest in that company. At that point, there's a decision that the business owner needs to reach, and that is, do I want to keep the business and continue to grow it, or am I ready to exit, and how do I prepare and make this business ready to sell and take to market? Next slide. So some of the internal qualitative value factors that impact, there's internal and external value factors that are going to impact the business valuation. And some of these factors, both internally and externally, the business owner has control over, and others the business owner does not have control over. So is there a strategic plan in place? Do we have a trained and experienced management team ready to take over when the business owner exits? What is the corporate culture like, and how is that going to change going forward when we all are rolling back into business? How does that culture change in our business? What kinds of systems and processes do we have in place? Are they documented? And if not, or if they are changing and evolving because of the coronavirus, how do we make sure that everybody in the workforce understands the new systems and processes? And do we need to outsource some of these things to a third-party service provider to come in and help assist us? Whether that's from a systems and processes standpoint, it might be from an HR compliance standpoint, having written and documented handbooks and different policies and procedures that need to be in place to make sure that we're compliant with laws and regulations. Having certain legal structures and protections in place. The ability to scale, again, for businesses that were well positioned pre-pandemic, they were able to scale or diversify into different products and services and really not only survive, but thrive during this period. Next slide, please. So some of the external qualitative value factors that we consider, customer concentration. This is going to be key for some businesses whose main customer, if they did have customer concentration, and that customer goes away or is not returning because of the pandemic, what does that do to that business? Market demand, that's going to be a big one that's going to be impacted. The market position of the company, the supply chain, competition. You can read through the list, but all of these things, again, are going to be very impacted because of the pandemic and the impending recession. Next slide, please. So what are my exit options and my transition alternatives? These are just some of the options listed. Again, depends on each business and the business owner's unique position and unique situation. But there's options to sell to an ESOP, sale to a strategic party or to a key employee. It might be a third-party sale, management buyout, or a gifting strategy, particularly for family-owned businesses that want to transfer the value of the business to the next generation. Next slide, please. So earlier in the presentation, I mentioned the impact of political and governmental forces. One area that we are anticipating seeing an impact because of not only because of the coronavirus, but because of the amount and level of government stimulus and the amount of different loans, the PPP loan that will be forgivable. How is the government going to recoup all of that deficit? So currently the 2020 estate and gift tax limits are set roughly $23 million per married couple, which is up from $11.4 million in 2019 for single, $11.58 for single currently. And that is set to sunset in 2026. But with the upcoming election, it is very likely that regardless of which party takes office, we will see a decrease in that gifting limitation and the estate limitation. And so from a transition standpoint and planning for a succession plan, if you have a taxable estate or think you may have a taxable estate, given the value of your business, because for many business owners, the value of their company makes up a vast majority of their wealth, would it be smart and strategic to start gifting some of that now to the next generation and getting that out of the estate and into the hands of the next generation, perhaps while maintaining ownership and control of the company until you're completely ready to step out? So that's a huge opportunity that I see for a lot of our clients. We work with a lot of family-owned businesses, a lot of closely held companies, and right now we're looking at ways to help them minimize the potential tax liability that they may or may not be exposed to if these limits should change prior to 2026. Next slide, please. So our role is to assist as a valuation and transition consultant. And again, I want to be mindful of everyone's time. I know I'm coming up to the end here. If anyone has any questions or comments or would like to have a conversation about their specific company or their specific situation, I would be happy to have a conversation with you offline and schedule a time to talk. I do appreciate everyone's time today. Thank you so much for joining me. I'm sorry I didn't get through the presentation all the way without some technical difficulties, but I appreciate you joining me this morning. Thank you.
Thanks, Mary Beth. And like she said, if you guys have anything or any questions that you would like to ask her, feel free to reach out. Thank you for joining us for today's webinar on what is life after coronavirus, impact on business valuations, and opportunities for succession planning. We hope the team was able to provide you with some valuable insight and to make sense of these current government recommendations stemming from the COVID-19 crisis. If you sign up today and realize that you have additional questions, you're always welcome to reach out to Mary Beth directly. You can also contact any of our Rea team members by clicking on the People section of the firm's website at www.reacpa.com. Don't forget to watch your inbox for an evaluation survey, access to the recording of today's webinar, and more. Thank you again, and we hope you guys have a wonderful rest of your day. Oh, Mary.